And Michelle Schneider, Chief Strategist at MarketGauge, joins us for more. Good to have you on, Michelle. Let's talk about the S&P 500 flat after hitting new milestones over the past couple of sessions. Dow also, slightly up. NASDAQ ended in negative. Markets, they have already priced in an expected hold on rates by the Fed. So what's keeping them more downbeat?
Well, a couple of things is even though lots of things have been priced in, there are other sectors of the market that really haven't kept up. And I think when you get a divide, like you see, let's say, for example, with NASDAQ versus the small caps, widen to a point, it becomes unsustainable. And one of two things have to happen. One, of course, would be that the small caps and some of the inside sectors of the U.S. economy, like retail, transportation, would catch up a little bit to narrow that ratio. Or the other would be NASDAQ and the S&P 500 might start to fall. And so I think we're at this very pivotal point right here. A lot of eyes were on the earnings today. And even though, as you mentioned earlier, they beat, there's been a down move in the aftermarket. And so what we could see is if NASDAQ falters, considering it led us up here, then we will start to see maybe a bit more of a correction from these lofty levels.
Let's look at the Fed first before we get into dissecting the big tech earnings. Now, core PCE hit the Fed's targets, but it doesn't. But of course, we know that it doesn't include the volatile food and energy prices. Would Middle East tensions, the oil price fluctuations, supply chain worries, would that push a Fed rate cut further down the road?
Well, one would think that if they use a rational mind, they should keep the pause until they see what happens going forward with the Middle East, because we're already seeing effects to the supply chain. And of course, oil is the big X factor, even though it hasn't exploded to the upside. It's flirting with that $80 a barrel, which would be a breakout area by a lot of technical traders. And so at this point, with the Fed, we have a perfect scenario if everything stays the same, right? We have the Fed funds rate and the PCE and the CPI numbers somewhat normalized, which is why you're seeing so many economists calling for a soft landing. But we've also seen signs of things under the hood not being so rosy yet, like a lot of the layoffs, maybe the jobs report peaked. Obviously, like I said today, the earnings being somewhat disappointed in terms of how the street welcomed them. And so if the Fed decides to go more in the route of let's protect the economy, particularly in an election year, versus let's not worry so much about what happens in the Middle East and inflation, they can find themselves really in a difficult spot. So I think that's why they're going to come in and say, well, we're watching. And they will be very neutral in terms of what they commit to in the future, if they're smart.
Well, we're talking now about big tech earnings. The stakes obviously are high, and it is quite a driver for equity markets this week. Mega cap names, they've contributed quite significantly to the S&P so far this year. Would it still be a key theme this year?
Well, it could go either way, actually. I mean, we've seen money rotate from one index to another or one sector to another. That's just the way markets work. So it wouldn't be the unhealthiest environment if some of the money rotated out of the growth and big tech stocks into more stocks that are relevant to actual growth in the U.S. more domestically, not the industrial complex so much, but some of those small cap, the companies that really make goods in the U.S. and distribute them in the U.S. That wouldn't be so bad. What would be worse, of course, is if everything starts to collapse as a result of disappointment that the NASDAQ may not be able to lead, at least in the near term. So, I think the jury's out on that, but some of us would probably welcome some kind of correction in those big tech stocks, especially when you're looking at names like Microsoft that reported well, had an initial down move, but at the same time has, an incredible future with AI.
Yeah, and Michelle, has the market properly priced in the risks of sticky inflation in their stock valuations?
That's a great question, Liz. I don't think so, actually. I think we've become too complacent on the inflation battle has been won. Clearly, the PCE numbers, as you pointed out, excludes energy and food, but even CPI, we know that they can be manipulated, those numbers, and they're also lagging indicators, not leading indicators. So we saw today, for example, in the U.S., a lot of the food prices, the grains, actually rally, looking like they bottomed. On top of that, if you look at history and you look at the 70s, where we had basically a peak to trough from 75 to 77 in CPI, and then we started to move up towards that crazy inflation in 79, we're actually almost a mirror image of that right now, which means if history rhymes here, any misstep by the Fed, escalation of the war, let's not even mention just the Middle East war. We still have Putin out there, and that's been unresolved as he's starting to get sniffs of less money going to Ukraine by the Western countries. So yeah, any of this could be a trigger for a new super cycle in inflation and definitely catch a lot of the market off guard.
All right, Michelle, thank you for that. Michelle Schneider there, Chief Strategist at Market Gauge.